We just went through the CBRE report on how things are shaping up for the Canadian real estate scene for 2024. And guess what? There's some pretty interesting stuff to share. Yeah, there are still going to be hurdles, but this year is likely going to be a pretty good year to dive into Toronto real estate based on the report. And we've narrowed down some of the best opportunities you should consider. So sit tight because we're going to break it all down for you. If you're new here, we're all about helping you make better real estate investing decisions in Toronto. Don't forget to like and subscribe if you enjoy our content. Now let's dive in. First up, let's talk about Canada's economic forecast. If you want to invest in the country with the best growth potential, it looks like Canada's the one based on the CBRE report. We're leading the pack amongst the G7 nations when it comes to population growth, GDP growth, and employment growth, and that's generally good news for real estate investors like us. But here's the twist. When we zoom in on the GDP per capita, we're not expected to do as good compared to some other countries, and it's already honestly showing in the latest GDP releases that we've seen lately. And as this trend becomes more and more noticeable, it's crucial to shift our focus to cities in Canada with the strongest economic growth potential, which is where Toronto will definitely stand out. If you're thinking about a city in Canada with good long-term economic growth, Toronto is probably top of mind for many people because we do have the most diverse economy spanning finance, technology, healthcare, and education in Canada. And at the end of the day, because of this, Toronto will end up weathering economic storms much better than other cities that rely more so on single economies. The next insight on this report comes from cap rate trends. Here's the scoop on cap rates. They're closely tied to interest rates. So what happens is when borrowing costs are high, investors will need to see a higher cap rate or rent yield to justify their purchases. Now, as interest rates start to stabilize nowadays and then start to fall later on this year, likely, and into next year, we'll likely see cap rate trends follow too. All right, so let's break it all down for real estate investors in terms of what this means. When we're looking at a potential purchase, we use market cap rates and expected rents to determine its value. So if cap rates are starting to stabilize, this is an indicator that we will see more stable property values. And as cap rates begin to drop with falling interest rates, then property values could see an uptick based on simple math. And this dynamic basically spells good news for real estate investors who are looking to enter the market these days. Now let's look more closely at the multifamily real estate trends highlighted in the report. The major takeaway here is that our ongoing struggle with a housing affordability crisis probably won't go away anytime soon. The first reason is that the supply crunch isn't easing anytime soon, and right now we are grappling with high interest rates and high material costs, but the long-term barrier is the shortage of construction labor. And because of all of these barriers, this gap between the number of units needed to meet affordability targets by 2030 only will get wider from this point on. And guess what province will see the biggest challenges with this? You got it, Ontario. Now, we did touch on high population growth earlier. So when you combine high population growth with a supply crunch, rental vacancies will naturally continue to drop, and you can see this trend more obviously from this chart. And at the same time, because of low rental vacancies, rental rates will continue to climb as well. So here's another interesting chart that stacks wage growth, home ownership cost growth, and rent growth. Based on this chart, it looks like things were more or less moving in line with each other until 2015. And then at that point, it started becoming harder and harder to buy a home. But now it seems like this trend is starting to trickle in for renters too, with rents really skyrocketing much faster than income growth as well. Now, here's where it starts to get a little bit more interesting. Because there is a gap between market rents and existing rents, and it's probably going to grow, this is keeping tenants from moving. In Toronto, for instance, the turnover rate is a mere 8%. So what this means is that even though rent growth can be as high as 25% if they turn over, the rental units that aren't turning over are only getting a much lower 5% rent growth. it's not actually that bad, but a lot less than what it could be. So taking a step back, the CBRE does think that 2024 is an year of opportunity. And for us, we'll even add in a year of cautious opportunity to make it more clear. So first off, the cost of capital is expected to improve, making it more attractive for investors to jump into the market. Secondly, property values do have the potential to climb higher too, because cap rates are stabilizing and might even drop later on. And then the rental market is expected to remain strong with low vacancies and continued rent growth. But let's not forget about the challenges, especially when it does come to units under rent control. And as market rents continue to go up, this gap between existing rents and market rents might just keep growing. So if you are stuck with lower rents, this not only will affect your rental income, but your property values will likely be impacted too because of cap rate valuations. So now with the government really pushing more missing middle housing stock growth and making it easier for all of us to create new rental units in houses, these projects look even more attractive for investors to take on once you factor in new units not being under rent control. The biggest red tape before was zoning. So even if you wanted to pay to get it done, you simply can't. But starting last year, every single house in Toronto is now allowed to create up to 4 units, which is huge. And other things are going to get easier as well. For example, they scrapped parking requirements already, and we're already seeing lower development charges. Plus, there's also the added boost from increased HST, new rental rebates at the federal level. So all of these reasons are precisely why we are seeing a lot more investors come to us considering these initiatives these days. Now, the most popular option for newer real estate investors would be to take a single family home in a rental neighborhood and then convert it into 2 or 3 units to boost rent yields and likely boost values too. And if you want to go one step further, these clients might be planning backyard house builds afterwards to further improve their rents. And then for max return potential for the more experienced investors, some of these investors are actually looking into the development space lately, since Toronto zoning rules allow 4 units as of right. Now, this is definitely not for everyone, but if you do want to maximize rent yields on a house, this is something you might want to consider. And then for the very rare wider lots, you might even think about taking things one step further, severing a lot and then creating not just 1, but 2 fourplexes side by side. And that's how you can get maximum value lift. And if you are curious about what Toronto real estate and investment projects might suit you best, just give our team a shout and we'd be happy to take a look at your situation and help you weigh your options. We're not your typical real estate sales brokerage. Instead, we focus on using numbers to make better real estate investing decisions in Toronto. And that can mean looking for stronger investments with positive cash flow, thinking about risk management, and looking for ways to boost returns like value add renovations and gentrifying areas. If you do want to discuss your private real estate situation with us, just head over to this link here to set up a time to chat. You can also check out more content on our website or find us on social media. And if you haven't done so already, please like, subscribe, and share this video if you think someone else might like it too. Thanks so much for watching, and I'll see you in the next video. Bye.